Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. As Chief Investment Strategist at iCapital, a global alternatives platform, Anastasia Amoroso is responsible for helping the firm's clients understand changes in the macro regime and how capital should be allocated in response. We start our discussion by considering the current state of affairs, of high interest rates, of correlated moves in stock and bond prices, and resilient economic growth, and exploring where history is and is not relevant. Here, Anastasia highlights the degree to which both consumers and corporations are far less sensitive to interest rate increases than they were in the pre-GFC era. Higher rates are a concern, but they need not derail the case for risk assets like stocks, which have delivered good returns amidst higher rates in the past. For Anastasia, an instructive framework for evaluating opportunity is one that considers valuation, positioning, and a catalyst. And in the context of this last factor, she notes favorable earnings revisions, which are showing signs of recently bottoming, and strong earnings growth, specifically in the tech sector. We spend the bulk of our time on the important topic of diversification and the faltering performance of the traditional 60/40 portfolio. She highlights exposure to global macro hedge funds, a strategy that delivered a 9% return in 2022 as both the stock and bond market lost nearly 20%. We finished the conversation by having Anastasia reflect on the state of female careers in financial services. She states that the industry has become more inclusive and more representative of women in leadership roles. With this progress noted, she sees a gap in women serving in the middle, between junior and senior roles, potentially the result of the unique demands on females that often include family responsibilities. Ongoing attention to office-life balance and creating a degree of flexibility in work is likely one part of the remedy here. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Anastasia Amoroso. My guest today on the Alpha Exchange is Anastasia Amoroso. She is the Chief Investment Strategist at iCapital, a global alternatives platform. Anastasia, it's great to have you on the podcast today.
Thanks so much, Dean. Great to be with you, and I look forward to the conversation.
Well, we speak at a time of interesting and in some ways unstable market dynamics. Certainly the back end of the yield curve has been a vast topic of conversation. This expectation that the US would be in recession by now has been yet fulfilled. Still a lot to be had here just in terms of the business cycle and where this economy is going. But let's just talk a little bit about your career history. So you've been at iCapital for a little bit now, but you spent a long time at JP Morgan. I'd love for you to just take us back to the beginning for you. Talk to us about your roots. How did you get into the business? How did your interest in financial markets and studying the economy, how did that come to be?
Thanks for letting me do that. And it has been 2 years since I've been at iCapital, but you're right. Prior to that, I had several different chapters, and that's how I really like to think of kind of anybody's career progression is certain chapters that are interlinked, but one builds one upon another. I started, for the most part, my career at Bank of America Merrill Lynch at the time, and I'll come back to that in just a minute, and then went on to spend 8 years at JP Morgan, and after that, of course, joined iCapital. But I guess to really start from the very beginning, it's interesting you asked, how did the interest in finance really come to be? And back in college, I actually started as a political science major. I was really keen to look after all the global events and politics and policies. It was really interesting to me, but somewhere along the way, I took this political economics class and we dove into the different economies and how they drive policies. And that really is when the light bulb went off for me, is so much of what drives policy is rooted in economics, is rooted in finance. And that's how I ultimately ended up switching my focus and concentration to finance and still with a minor in political science. And it's interesting because now when I think about my role as an investment strategist, it's really a confluence of all of those things. We can't only think about markets without thinking about geopolitics, unfortunately, with the events evolving as we speak. Certainly can't think about markets and policies without being able to communicate about it. So journalism was also a big part of my background as well. Having said that, as a background, I spent a big part of my career at first at Bank of America Merrill Lynch. And speaking of crises, I joined in 2005, but I started managing discretionary client portfolios in February of 2009. So you might imagine the state of crisis that we were still in back then. But that, as I look back on it, was a very formative time in my career. So having done that, having spent 8 or 9 years at Bank of America, Merrill Lynch, at the time, I was managing global client portfolios, 5 different asset allocation models. But I wanted to get a little bit closer to Wall Street and closer to really rolling up my sleeves and digging into the economics of it. And so I joined JP Morgan Asset Management at first as the global market strategist. And then 4 years later, I joined the private bank, really working with the bank's ultra high net worth clients. And it's been a terrific experience until 2 years ago. What really occurred to me is the world is moving and shifting towards alternatives. And so when I did get the call about iCapital, which is a global alternatives platform, it was an easy decision to make that move.
Outstanding. Well, you covered a lot of years there and a lot of market cycles as well. And one of the things I try to do in conducting these conversations with experts like you is just to try to survey change a little bit. And as you talk about 2009, I just couldn't help but think, okay, the worst part of the financial crisis is behind us, but there's just a lot of damage in the aftermath. What ensues is just an environment that is so opposite to what we have now. It's monetary dominance, and now we have, in a lot of ways, fiscal dominance. And one of the things I wanted you to comment on, we all look to the past to try to learn, but we have to recognize that the past is often so different in ways that it makes comparison difficult. You've written a couple things, for example, on the sensitivity of the consumer to higher rates. Let's say in the pre-crisis period of 2007 and 8, both in terms of indebtedness, but also its sort of yield curve exposure versus now. I'd love for you just to start there and just talk about the differences that you observe in what the consumer faces now versus previous periods.
I think it's the exact right parallel to be drawing, which is how is the consumer faring today versus during the financial crisis? I think what is caught a lot of people off guard, people who've been calling for a recession and more of a crisis this time around, is the fact that the US economy, the US consumer is a lot less interest rate sensitive than we used to be. And when I look, for example, at the percentage of consumer debt that is floating rate, today it's about 11%. When I contrast that with where we were during the financial crisis and kind of at the start of the prior hiking cycles, it was more like 25% of the consumer debt was floating rate. So when you compare and contrast why we had the global financial crisis back then versus now, is because back then close to 19% of mortgages were floating rate. Today, 4 or 5% of mortgages in the United States, I should emphasize, are floating rate. So that's why, as unpalatable it is to try to think about buying a house with an 8% mortgage rate today when it was 2.5% or 3.5% a few years ago, as not fun as that seems, that's not a huge financial burden. That means that every single mortgage out there has to reset. So that's a really, really key distinction. And then the other, when I think about the consumer, is I think we have reined in leverage. We have learned how to use leverage responsibly and not too much of it. So when I think about the household debt today relative to household net worth, once again, it is lower, much lower than it was leading up to the financial crisis. So when I put all of that together, that's why you couple that with some of the excess reserves that people still have during the pandemic. You couple that with the household net worth that has really reached record levels. And you couple that with these credit dynamics that are quite sustainable for the consumer. I think that's why we just had almost a 5% GDP growth in the third quarter of this year.
There's a corporate side of this as well. And I know we're going to circle back to the government side. Maybe that's where the vulnerability is ultimately shifted, but there's a corporate analog that I think has some similarity based on some of the stats that I picked up in your recent writing. to exposure to higher interest rates as well. I'd love for you to walk through what that looks like on the corporate side and the impact, at least so far, of higher rates.
Dina, I think you're asking a really important question, which is sort of the survey that we have been doing for the last few weeks or few months, which is trying to understand where are the piles of debt and who has the most debt and who's the most susceptible to a reset higher in rates. And as we talked about the consumer, I'm not overly concerned there. And for the most part, I'm not really overly concerned about the adverse impact of higher rates on corporates either. And I say that, for example, when I look at the S&P 500 companies, only 8% of their debt is floating rate. And we've also know that companies worked hard to extend the maturities of their fixed rate debt, and they've locked in, as a result, this low level of rates. So yes, there will be some maturities coming up in the next few years, but once again, it's not unsurmountable. And when I look at the interest coverage ratios, when I look at the net debt to EBITDA ratios for US corporates, they're really at quite healthy levels, again, for some of the largest corporates and certainly the S&P 500 companies. Now, having said that, there are pockets of concern that I do have, and some of it has to do with leveraged loans. Some of it may have to do with private credit, middle market loans as well, because those loans are not fixed rate, they are floating rate. And as interest rates reset higher, as we went from 0 to 5.5% in a hurry, the interest coverage ratios of some of these floating rate issuers have deteriorated quite a bit. So I do think that those pockets may be facing some dislocation and may be facing increased defaults. But once again, when I look at the universe of corporates and IG, I'm much less concerned about that.
Well, we've highlighted a couple of things that when you look backwards for guidance on trying to learn from the past, you've showed us that there are important distinctions, both on the corporate side and on the consumer side, whether it's behavioral or just what the exposures are to some macro variable like interest rates, especially given the extent of the move. What are some of the things that you can use for guidance? So if you look back in history, and I know you study market cycles, what are some of the things that you're using as guideposts based on historical experience that do matter at this point, that are still relevant in terms of making an assessment of where we're going?
I would say a couple of things to that. I want to start off with maybe a couple of lessons learned from prior moments in time and moments in history that I carry those lessons as we talk about portfolio allocation today. And then we could also talk about a bit of a multi-factor model that you apply to investment decision making. When I think back to, again, starting to manage discretionary portfolios in February of 2008, one of the lessons learned from that is, as bad as things seem in the moment, it's really important to understand that they tend to get better over time. And that's just the natural course of markets, the natural course of history. And so as an investor, you can't just put the blinders on and say, well, I'm bearish because I'm looking at this one factor and this one variable and this indicator, and it's making me quite bearish, or vice versa, bullish. So one of the lessons learned is you have to develop a formula that's going to allow you to adjust and adjust quickly. And if the facts on the ground change, you change your views, or rather you update the views. And I think that's really important. So one of the things that I pay really close attention to is the incremental improvements or deteriorations, or the so-called second derivatives. Now, to kind of fold that into the model that I tend to use, this multi-factor model, is I tend to look at three factors, which is valuation, positioning, and a catalyst. And when you do that in combination, it really gives you a full picture of what might be going on. And so I'll give you an example. You might be going into a tough economic environment, like in 2022, for example, or before that in 2018, for example. You might be going into a tough economic environment where all the signs are pointing to a recession. But guess what? If valuations have already repriced for that, we might have already priced in some of the worst case outcomes. So then from a contrarian investor perspective, I want to always understand what is baked into the valuations. So if valuations are suggesting that a lot has been priced in, and so does the positioning, that's a pretty good setup for a potential contrarian bullish investor. And so I tend to look at valuations, but I also tend to look at positioning. I think that tells you a lot about the market setup. So, for example, when systematic investors reduce their positioning drastically, when hedge funds reduce their positions drastically, when mutual fund managers raise their cash levels above certain threshold, that really tells you that a lot of bearish sentiment is already being reflected in the markets, and you're likely out of incremental sellers. So as a buyer of risk assets, that's the setup I look at. But there's also another important distinction, and that is you can have a cheap valuation, you can have unloved positioning, but if there's no catalyst, the market can actually stay unloved for a while. And so the third component of this multi-factor model, so to speak, is thinking through the catalyst. And I would say that tends to be a less quantitative exercise, but a qualitative exercise of what is likely to drive the markets. Is it the change in the direction of policy? Is it the change in the direction of yields? Is it the change in the direction of inflation? And, if you can get that change in direction right, I think you can, in fact, at times time the market, kind of applying this formula.
Well, you had mentioned some of your previous work in overseeing commodities-based portfolios, and I just wanted to bring into our discussion a recent guest, Cameron Dawson, who's the CIO at New Edge Wealth. And we were talking about the gigantic sell-off in energy that really started in late 2014. It went into 2015, and really the whole sector was kind of cast away. And in a lot of ways created a fantastic buying opportunity. It took a while. I just wanted to run with this concept of what's in the price, and then specifically have you relay some of your experience in the commodities sector. I know that energy is a focal point for you in some ways because of its diversifying potential for a broad portfolio. But just talk to us a little bit about your experience in commodities and maybe specifically in energy equities.
We were covering the energy crisis of 2015 quite closely, and it has been amazing to see just how different the energy industry is today versus what it was back then. Back then, it was about leverage. It was about production at all costs. It was about growth at all costs. And you fast forward almost 10 years, and it's about managing the debt levels. It's about prudent leverage, and it's about generating cash flow and returning a part of that cash flow to shareholders. So from an equity investor in energy, there's a lot to like, because if I have a company that is prioritizing cash flow, that is trying to drive down the break-even cost of producing that incremental barrel, if I have a company that is prioritizing dividend growth to shareholders and also buybacks, that's a really great place to be. And also when you look at the leverage, for example, of energy companies today, it is so much more in check than it was back then. There's a lot to like. But then there's the actual commodity piece to it as well, which is we are in this environment where we have underinvested in energy infrastructure, partially because of the CapEx discipline from the exploration and production producers, partially because of some of the ESG efforts. But the fact of the matter is we have not invested in energy infrastructure. And today, when I look at the commodity environment, when I look at demand for mobility, for example, recession fears or not, demand for mobility is exceptionally strong. It is strong in the US, it is strong in Europe, it is picking up in China. It is demand for basic transportation fuels, but also jet fuel as the flight traffic opens up. So mobility demand is exceptionally strong, which bodes well for oil demand. And then at the same time, you have this stance of OPEC plus right now that they want to be driving down the global inventories. Because if they do that, that supports a higher oil price environment, and that could, in fact, in turn, incentivize the CapEx that we haven't had. So putting all that together, I think we're in an environment where maybe rates high for longer, it's oil high for longer. And if you are in a camp that inflation may not be coming down to 2.5%, or there's a risk that it's not, oil provides a pretty significant hedge against that. If you are looking around the world and looking at the geopolitics, and geopolitical risks, unfortunately, are not subsiding, they're escalating. Oil is yet another reason to have an allocation to in your portfolio to hedge those geopolitical risks as well. So I like the commodity itself. I also like the energy company tied to the commodity because of some of the cash flow dynamics. This is not 2006 for oil and gas. This is 2023. And I think it's a pretty good vintage year.
We're going to pivot to your time at iCapital. And before we do that, I wanted to have you share just a little bit of the experience in the role as Chief Investment Strategy at JP Morgan Asset Management for the private bank, and just this interaction with clients amidst, if we go back, even 5 years, this incredibly low rate environment that persisted for a long time post the GFC. It wasn't always low volatility. It was certainly low rate, but you had these kind of fractures in the market. China in 2015. We all remember the VIX event in 2018. So there were some scary events along the way. I just was curious if you could share some of the work that you did that you found important in keeping clients invested, but also very risk conscious. Just this tendency for markets to suddenly go from very low vol to something much higher can shake people out. What was the process of keeping folks invested, but also very risk aware?
There's certainly no shortage of volatility events. During my time at JP Morgan, I started in 2013 and spent 4 years in asset management, including covering the energy and the commodity crisis of 2015, and then 4 years at the private bank. And it was the US-China trade disputes of 2017, 2018. It was the COVID crisis at the tail end of it. So there's definitely a lot of volatility to get through. But one of the lessons learned, the investment lessons learned in my career that I think has been helpful in talking to clients about how to manage their volatility is there's this saying that the markets stop panicking when policymakers start panicking. And guess what? The policymakers inevitably start panicking when the markets panic enough. I think back, for example, to that infamous Mario Draghi speech was July 26, 2012, when he said that the ECB is ready to do whatever it takes to preserve the euro. And you remember the pickup in risk assets after that point. And so you use lessons like that to, for example, manage through the COVID pandemic. And I remember talking to clients and doing presentations in March of 2020. And despite the fact that it seemed like the end of the world back then, the experience that we had to fall back on is policymakers will go into panic mode, which means there will be action, which means that this market will be supported. And as difficult as it was for us to process as human beings, everything that was going on at the time, as investors, the mindset that we had to have and manage through that volatility. So that would be one approach, of course. And then a lot of the conversations did have to do with strategic allocations and how do you build a portfolio that withstands the market cycles. And I would say part of the conversations until recently, until maybe coming to iCapital, has been somewhat incomplete because a lot of prior strategic asset allocation models have relied on a traditional 60-40 portfolio. And sometimes you would think a portfolio is diversified if it has small caps, large caps, high yield, investment graded treasuries. But we've seen very clearly in 2022 that that's not actually diversification. Not only is high yield correlated to large cap or small cap equities, but now you've also got treasuries that are correlated to equities as well. To your point, Dean, about what has changed, what is changing is that if we're going into this very different environment of 5% rates, I call it going back to the old normal. That's the old normal regime before the financial crisis, where the 10-year treasury actually did average 5.5%. But in that environment, stocks did still manage to perform, credit still outperformed treasuries, private equity delivered solid 20% plus returns. So there are ways to manage the portfolios for today's 5% environment. But I would say the old normal regime of interest rates likely means you need new tools in your portfolio. And so the way that the conversation has shifted recently with clients at iCapital, and I think really elsewhere, is how do we incorporate additional tools in the portfolio that can help us withstand this high for longer rate environment?
Well, as you looked back and you talked about the fear from policymakers effectively being almost a risk-on event ultimately, you mentioned Draghi in 2012. I love that. Whatever it takes, and believe me, it will be enough. He executed on that and had a tremendous capacity to do so. There was everything pointing in the same direction. We have a chance to lower risk spreads. It's clear inflation is well below target, and had the capacity to buy bonds. And then you mentioned 2020, which is, of course, different. Certainly the Fed and other central banks, massive stabilizing efforts into markets. The Fed's QE was just incredible. But also this fiscal side, this fiscal response was just tremendous as well. It was a tremendous crisis. So there needed to be a tremendous response. And my question is, I'm just curious if you think about both the fiscal and the monetary side on a going forward basis, should the market get into trouble, we all like to talk about those puts underneath the market. Is this compromised at this point, just given where we are? Should we be able to rely on it? How do you think about the come to the rescue of policymaking should we run into trouble going forward?
I do think it's quite different this time. One of the things I did a lot at JP Morgan back in, let's say, 2013 was talk to a lot of financial advisors and clients. And inevitably, I would do a presentation. And when it came time for questions and answers, the top question, even back then, was always, well, what about the US government debt? When is that going to become an issue? And do I have to worry about it? And up until now, the answer really has been no. You don't really have to worry about it because the debt service as percent of revenues, government revenues, was about 6%. And no, you don't have to worry about it because we've extended the maturities of the US government debt. And by the way, rates are at zero. But think about how different the environment is today, where we have budget deficits that we're running of 5 or 6% and on track to get wider, where we have $8 trillion that we will have to refinance in maturing debt in the next year. And by the way, we're not refinancing that at 0 or 2.5%. We're going to refinance it at, let's say, 4.5%, or maybe even higher. So that is a drastically different environment. And when you forecast that out, if you think it is high for longer interest rates, then the debt service goes from 6% that I didn't have to worry about back then to 21% by 2030 or so. So that is a drastically different environment that makes this very different this time, that we have to be concerned about and the policymakers have to be concerned about. The other thing I would say that it's drastically different this time is for the last 14 years, we've been in an environment of quantitative easing. And it's been a nice place to be. But today, we're in the quantitative tightening, QT environment, which if you think about it, it is the exact opposite. And whatever happened under QE is now having to be unwound under quantitative tightening. So if we had QT that could finance our budget deficits, that's no longer the case. If we had quantitative easing that would keep the level of 10-year treasury rate depressed, that's no longer the case because the Fed is not sitting on the 25% of US treasuries outstanding, taking that out of the supply dynamic. That's no longer the case. The Fed is not buying, and they're also actively winding down their holdings of treasuries through QT. So as a result, the price insensitive buyer that was in the market for US treasury for so long, which was the Fed, which was commercial bank, which is foreign central banks and others, those insensitive buyers are not going to be as big participants in the market. And so as a result is the price sensitive buyers, mutual funds, individual investors that will have to buy the treasuries. So my point is, under this QT regime, we can't expect there to be a cap on rates because of the Fed. And so to your point, the put that was there before is no longer there. So investors have to count on what is the economy doing? And that's what's likely to drive stock prices the most.
There's two risks with these higher long end rates. One is the sharp, sudden gapping out where market clearing doesn't really work. It's hard to imagine with something like the Treasury, but certainly these moves have been very unsettling. I think even to Fed officials, you're starting to see officials like Lori Logan talk about term premium, and they're trying to understand the why of the recent bear steepening. One stat I wanted to put in front of you that I just came across from Goldman, they said that over a 30-year period from 89 to 2019, their estimate is 40% of the growth in the stock market, of the returns in the stock market, are due the combo of lower rates and more favorable tax policy. And so my question is just around the potential that these higher rates, and let's just stay with the back end mostly, if that's sustainable, how does that impact how you think about both the economy and then just about prospects for risk securities, risk assets like stocks?
Higher level of rates should slow down the economy, but I don't necessarily think it derails it altogether. It should slow down the returns in the equity markets. But again, I don't think that means we're in for a decade of negative returns. The reason I say that, obviously, cheap leverage enabled, for example, to use leverage in private equity returns, and they have been quite favorable. Cheap cost of capital and interest rates that were pegged at zero or very low in the case of the 10-year treasury allowed for a lot of multiple expansion that drove both the outperformance of private equity, but also public equity markets. And I think that's what's behind that stat of 40% of the returns were driven by this policy. We're no longer going to be counting on a substantial multiple expansion and or cheap leverage that's going to make those return on investments more attractive. Having said that, that does slow down the economy, should slow down the economy, that should slow down the equity returns, but it shouldn't derail them because there is a third driver of whether it's public markets or private equity, which is economic growth. And if I look at the technology sector, the net debt to EBITDA for the tech sector is 0.6 versus 1.4 for the overall S&P 500. But if I look at the earnings growth, for example, of some of the tech companies, depending on the tech company, but 10, 20, 30% earnings growth is what we're looking at within the sector. So if you can identify the sectors, the companies that are able to deliver revenue and earning growth, even without multiple expansion, that's what should drive over time those stock prices. So this is why I say slower pace of returns, but going back to, once again, 2003, 2006, for example, rates were around current levels, and yet equities performed, credit performed, and private equity also delivered 20% plus returns. Slower returns, but not derailing them.
Well, you've got a sub-series as part of your work at iCapital called 60/40. So that portfolio, of course, has seen better days, certainly in 2022 and even beyond, especially on the bond side this year. Let's talk a little bit about iCapital, learn a little bit about the firm. It seems to make a very interesting use of technology and provide additional avenues to deploy capital and seek diversification beyond just something like 60/40. Tell us about the switch that you made from JP Morgan to iCapital, why, and then how your role is different, and then also a little bit about the firm.
As I mentioned in the beginning, when I got a call about iCapital, I wasn't really familiar with the firm, but after doing a little bit of research, I realized this is a global alternatives platform that is really focused on democratizing alternatives and making sure that it's not just institutions that have access to the private markets, but also private clients and private wealth clients. And the reason why this was so attractive to me is because even back at JP Morgan, as we would meet with a lot of ultra high net worth clients, a lot of them would come to us and say, well, tell me where the innovation is happening, whether it's in digital, whether it's in healthcare, whether it's sustainability, whether it's somewhere else. Where's the innovation? And I'm going to figure out how to go invest in it in private markets. So that's what resonated with me and made me think about making the switch to alternatives and private markets, because when I look today around the world, there's so many more private market companies, for example, that are doing things like artificial intelligence, that are working on decarbonization technologies, that are building kind of the next generation of precision medicine applications. And there's a lot of private equity and venture capital managers that are financing those companies. So that really resonated with me. If I want to invest in innovation, I want to be looking at private markets. But of course, having learned more about iCapital, the other thing that really resonated with me, and I'm so excited that we do at the company, is we really are expanding access to private markets, expanding access so that private wealth clients can participate in that as well. iCapital is really a platform, and we sit at the intersection of GPs, the general partners, the asset managers, and we help them to connect with LPs, the investors in private wealth, We help connect the ecosystem through technology, through access, and also through education. To kind of summarize some of the issues that the industry has faced in expanding access to alternatives, first of all, previously, if you couldn't write a ticket size of a very substantial amount like an institution can, it was difficult and or impossible to get access. At iCapital, we help the investment participants access alternatives at a much lower minimums that you would need to as an institutional investor. And then the technology pillar, the other thing that's really difficult in the industry is there's a lot of legacy systems and there's a lot of paperwork intensive ways that traditionally were used to subscribe to alternatives. There's a subscription document, there's a manual process, there's fragmented systems. And one of the key technologies at iCapital is to streamline the process of subscribing to the fund, monitoring the fund, executing the capital calls from the fund, managing the distribution. And we really have this suite of technologies to manage the entire life cycle of that alternative investment. That, to me, as an investment strategist, is extremely attractive because if we can solve the access issue for alternatives, we can solve the technology issue, and if we can provide the education and also discussion of the timely market opportunity for which type of alternatives and how much clients should be thinking about, I think we can, in fact, greatly expand access to alternatives for the private wealth channel.
How is your specific work at iCapital consumed by clients? How is it delivered to clients?
So the work that I focus on at iCapital is really helping our clients, the limited partners, the financial advisors, and their clients understand what does the macro environment look like and how should we be allocating to alternatives and which type based on that. Some of the conversations that we might have, as I mentioned, this new regime requires a new set of tools. And clients may want to look at things like private credit, for example, that has done really well this year and last year, while the 10-year treasury yields continue to sell off and the long-term treasuries have continued to suffer. Clients may want to look at a multi-strat hedge fund strategy or a macro strategy that really helped protect the downside and maybe even deliver the upside when this traditional 60-40 portfolio was down. So part of my work at iCapital is really helping clients understand what is the macro environment, what type of investment opportunities we should be thinking about in terms of alternatives.
At a given point in time, there's always some subset of the vast amount of indicators that we look at each day, whether they're market prices or economic data points. There's so many ways to slice and dice it to create what I would just call a risk mosaic. I'd be curious just to learn a little bit more about the metrics that you're looking at now that are especially important to your process right now, that you think are especially informative, given where we are in both the financial and economic cycle.
There's a couple, and one would be more related to the equity markets and the other one to the broader economy. I mentioned before the valuation plus positioning plus a catalyst, but one of the catalysts that we saw for equity markets to turn around late last year is that earnings revisions may have bottomed. For a long time, there was this concern in the market. Well, if there's a recession is coming, don't earnings have to come down and are they still high enough? But when you looked at the earnings revisions, first of all, you saw that the 2023 earnings revisions for the S&P were already cut back by 10 percentage points. And in a typical recession, the earnings revisions typically fall, or the earnings fall by 13%. So if you thought that we were going in some sort of an average or modest recession, then chances are, given the reset in earnings expectations, we have already priced that in. And so that was a really, really key indicator to be looking at for kind of the direction of the market. The other thing that I would say earlier this year, we did see the earnings revisions ratio start to tick up for the S&P 500. So it seems like the downward revision cycle was now behind us. And as the economy was holding up, the earnings revisions were also going up. And when that tends to be the case, that's what drives not only the multiple expansion, but also the earnings expectations and therefore the markets. So that was a really, really key indicator that we obviously continue to watch. The other one, and this is maybe a little bit more longer term and macro, The other really key question in the market is, well, why has there not been a recession? When are we going to have a recession? And isn't the yield curve inverted? Isn't that a precursor of a recession? But to me, there's one other relationship that is really, really key in sort of helping us determine when and if there's going to be a recession. And that is a relationship between the neutral rate in the economy and the actual real Fed funds rate. And so the neutral rate for the economy is the rate that the Fed funds rate should be minus inflation, the rate at which the Fed is neither stimulating the economy nor restricting it. Well, if I look at the neutral rate today, the best forecasts out there from the New York Fed suggest that the neutral rate is somewhere around 1% in real terms. But when I compare that to the actual Fed funds rate minus actual inflation or inflation expectation, that rate is also about 1%. Now you compare that to, for example, 2006 or prior to that, 1999. And it was a different relationship because the neutral rate was higher back then. It was 2.5% or even 3%, but the real Fed funds rate was above the neutral rate. And if the real Fed funds rate stays above the neutral rate, therefore in restrictive territory for a period of time, that's what tends to cause a recession. But that is the key condition that we not yet have today. I think we might be just getting back to neutral. I don't think the Fed is even overly restrictive yet. And it certainly hasn't been that for a time. So that's why we've not been calling for an imminent recession. And until and unless that relationship turns for a period of time, I think that may continue to be the case.
We're all watching, of course, inflation and trying to parse out what the Fed's reaction function is to incoming data and trying to figure out if they're prioritizing what at least nominally does appear to be reasonable progress on the inflation front, of course, from a sky-high level, but it's certainly going the right way. And you could argue that it's going to continue to do so. Some of their statements almost prioritize the growth side of things or the labor market side of things, which I think have people a little unsettled. In other words, if the unemployment rate is stuck at 3.5% and we're convinced that it's got to go up for inflation to come down, we could argue forever about these things. But what do you see just coming from the Fed? How do you view how it will react to incoming data? Is there a risk that if policy is not restrictive enough, that they just need to do more? How do you incorporate all of that?
Well, they may not have to do more. They just may have to stay there. And, if I take that relationship that I described between the neutral rate and the Fed funds rate, if the Fed does nothing at all, but just stays pat around 5.5%, and inflation continues to evolve according to the forecast, eventually reaching 2.5% by the tail end of next year, then the real Fed funds rate, if this stays pat, will actually start to rise. What's 1% real Fed funds rate is likely to rise towards 2% sometime next year, even if the Fed does nothing, just because inflation is falling. So that's the first point. The second point ties into why the Fed may not do anything but stay pat around the current levels, is because I do think they're seeing increasingly more signs that inflation is starting to come down, that the labor market is starting to rebalance. And I say that because when we look at different types of inflation metrics, we break it up into core goods and core services. And core goods inflation, for example, has come down substantially. It was a little bit negative in recent months, but it's hovering just around 1% annualized if I just look at the last 3 months worth of data. If I look at the core services inflation, services or also stripping out shelter, you're also seeing that the last 3 months annualized pace for services is somewhere around 2.5%. So I think those are the indicators that the Fed is looking at. And of course, they couple that with the labor market. And yes, we recently had some strength in payrolls and job openings, but we have seen slower pace of job creation, certainly over the last year. We have seen some uptick in the unemployment rate, but even if the unemployment rate doesn't pick up, but the job openings come down, I think that's the rebalancing that the Fed is looking for in the labor market. And wage growth has moderated as well. So I think you take that together with slower pace of inflation, and the Fed is likely arriving at a place where they might actually be content with the current stance of policy.
Let's talk about diversification. Clearly, such a critical discipline in terms of portfolio construction and something around which the bond market effectively failed in 2022. And, you could argue this year as well. I was just looking at 3-month realized correlation between S&P and TLT. It's just a moment in time, but it's something like positive 35%. That's even higher than the highest point in 2022. You're just not getting the offset in the modern environment where risk on, risk off is just not really a thing, at least at this point. You're spending a lot of time on diversification, and the platform allows access to these diversifying strategies. I'd love for you to frame that out for us and where you think you can most favorably find opportunities to diversify.
We should talk as part of this about hedge funds and also some of the structured investment strategies as well. I mentioned before, there are different types of hedge funds, but if you're looking for diversification, first of all, the hedge fund universe as an aggregate provided a pretty great diversifying tool. But if you look specifically at relative value multi-strategy hedge funds that take advantage of different dislocations in capital structures or different mispricings, they trade the curve. But strategies that look for relative value, historically, those strategies have delivered great diversification benefits and low correlation to the rest of the portfolio. The other strategy within hedge funds that I would point to is macro, which goes after big macro trends, of which we had a lot of last year and this year. But macro hedge funds last year as an industry, as an index, delivered almost a 9% return in a year where the 60/40 portfolio was down 17%. And you might argue that, well, maybe the macro forces are not as strong this year and beyond because you've got the Fed is close to pausing, you've got equity volatility that has come down. But I think it's fair to say that we are in a very different regime of potentially higher normal state of volatility. And what I mean by that is the Fed is not going to be there to suppress volatility in equities and fixed income because of QE. We're now in a QT world. And we are in a world where maybe we squashed inflation and it's on the track to 2.5%, but we also have a lot of imbalances in the economy, whether it's the labor market, whether it's the lack of energy investment, whether it's the lack of general commodity investment. So maybe inflation pressures are still going to be elevated. So in that world, I think we can count on a higher steady state of volatility. And that would certainly lend itself well to macro managers to continue to find opportunity. So for true diversification benefits, I would look to macro and multi-strat relative value hedge fund strategies for that. The other thing, Dean, that I would point out is some investors think of having one or two tools in the portfolio, which is long stocks and long bonds. But the reality is, as you well know, in the derivatives world, there are ways to structure different outcomes solving for different expected market outlook. And so with the help of structured investments, we might be able to, let's say, for example, go long tech stocks, but give yourself some downside protection. Or we might go long tech stocks or the S&P or whatever your favorite stock is, but maybe give yourself some enhanced upside participation. If the S&P is only on pace to do 5%, we think, can you add some upside leverage and give yourself 2 or 3 times participation? That's a possibility with structured investments. And by the way, if you think about a structured investment, it is a function of the issuer, which issues a bond with a coupon, and that coupon is available to buy an options package. Well, the great thing about today's environment is rates are much higher. So the coupons available to buy that options package to structure the payoff you want, those coupons are much more significant. And that's why structured note pricing has been so much more attractive. So hedge funds and structured investment strategies, I would say, can be true diversifiers in the portfolio. And that's part of this enhancing and expanding the toolkit and this going back to all normal environment.
If 60/40 is the starting point, and it's just been so embedded in how folks think about the mix of assets, help us understand the degree to which folks that are clients of iCapital would stray from that in terms of introducing other diversifiers versus the 40 that's been such a staple in how people think about it. When you think about substituting away from just bonds, To what degree does that substitution take place?
Well, within that, we should talk about how can you manage a portfolio beyond the 60/40, but actually, how do you also manage the within the 60/40? Just to put some industry numbers out there, if you are an endowment foundation, institutional investor, you're probably allocating 40 or 50% of your investable assets in private markets, in alternative investments. As individuals, so far, individuals have been allocating somewhere between 3 to 5% of their investments to alternatives. So it's still very much close to a 60/40. But as we think about how do we realize the benefits of alternatives and move the needle, the industry numbers after running the optimization models really point to a 20% allocation, give or take, to alternatives, because that is significant enough to change some of the drivers of the portfolios. But at the same time, as an individual, you may not be willing to take the same illiquidity risk going up to 40% in alternatives as an institution may do. So that's the first point, is expanding the continuum, let's say from 60/40 to 50/30 and maybe 20%. The next question becomes, what do you actually put within the 50/30/20? And obviously, that's going to depend on your risk profile, whether you're conservative, moderate, or aggressive investor, whether you're focusing on income, whether you're focusing on growth. But I would generally say there's three reasons why you should add something to the portfolio. The first one is if it has the potential to increase your returns. And when I think about what can potentially increase the returns over and above public equities, it is private equity, it is buyout strategies, it is growth equity, it is venture strategies. Even if you think of it as a 60/40 portfolio, I would suggest that within the 60, it should be a continuum of public and private markets. The second reason why you should add something to the portfolio is, does it have the ability to potentially increase my income? And as great as 5% cash it sounds today, inflation is still 4%. So there's still a need to add potentially more income to the portfolio. And that's when I look to private credit. And private credit managers, especially in the new vintages, are underwriting deals that might have a 12, 13, 14% coupon, which, by the way, is floating rate. And so it doesn't carry the duration risk that a 10-year treasury might. So that, I think, is the other really interesting reason to add something to the portfolio, is can you potentially enhance the income over and above cash and over and above other duration sensitive assets? And then, of course, the third reason, which we talked about, which is, how do I add something to the portfolio that brings me actual diversification benefits? And certain types of hedge fund strategies and structured investments certainly fall into that diversification category. So it's beyond the 60/40s, what we do in terms of helping clients think through, but it's also how do you enhance the allocation within the 60 and the 40.
These markets are so challenging, they're humbling and always interesting. I find this environment with these short rates of 5% and all the action on the long end so fascinating, and really calls a very unique framework, I think, to chart the course going forward. Anastasia, this has been a great conversation. I really appreciate the insights. I would love to solicit a little bit more from you and kind of change course here and just ask you about being a woman of prominence in the field of finance and Wall Street. I've had several female guests on the podcast in the time that I've been doing it, and really try to end the conversation with a little exploration on that front. There's been a lot of initiatives to empower careers in finance for females. I'd love for you to share how you think those are going. Are you active in that realm? And what do you think needs to be done in order to create more success?
Absolutely. And it's been a great conversation. And I really enjoy this question, Dean, as well. And I've been in finance for almost 20 years. And when I look back on it, there's certainly been improvements. I do think it is a much better culture of inclusion. It is a much better culture of respect as I look across the industry. Two pieces of great news is that when you look at the number of men versus women that are entering finance, it is much more evenly split in certain cases. And I've seen classes of analysts entering, whether it's JP Morgan or Merrill Lynch and others, that have been much more inclusive and much more representative of women. And that is fantastic. I've also seen many more women in leadership roles. And I've been fortunate in my career to have a lot of role models to look up to that are incredible women in incredibly senior positions, managing through the good times and the bad times and the COVID pandemics, and doing that just so amazingly and successfully in an inspirational way. When you look at those two things, the people who enter finance and the people who rise to the top of finance, and how many more of those people are women, that's really fantastic. Having said that, there does seem to be a gap in the middle where, to this day, a lot of rooms that I go to, women may represent less than 3%. The other issue, as you go through the hiring process for not the most junior role, not the most senior role, but somewhere in between, there still seems to be either a lack of availability, a lack of interest, or a lack of female candidates for one reason or the other. And I think that's the part that still needs to be solved, is how do we make sure that women are not only entering finance and rising to the very top, but how are they also staying in finance through different parts of their life and their careers? And I don't know if I have this single right answer for that, but when I think about it, perhaps maybe from my experience, we know that a career in finance can be extremely rewarding, but it's also extremely demanding. And other aspects of life, family life, can also be extremely demanding and rewarding as well. But putting the two together and having the managers, having the company culture that supports this life work integration, supports it perhaps through flexibility, perhaps that's how you change it. Perhaps that's how you make sure that the middle also works for women, and the middle stage of the career in finance also continues to attract female talent. So, Dean, I think we've made a lot of progress, but there's still a little bit more to go.
Appreciate you sharing that. And that missing middle has come up many times, that there's a lot of recruiting, and then there's an increase from a lower level, but an increase in very senior ranks. But oftentimes the folks that start out at a young age in their careers on Wall Street at some point leave. And so just filling in the middle seems to be worth really focusing on as well. Well, Anastasia, I really appreciate connecting with you. This has been a fascinating conversation, and thanks for being a guest on the podcast.
Dean, it's been great to be here with you today. Thanks so much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.